Please welcome our panellists, President and Chief Executive Officer of CREO Syndicate, Régine Clément. Chief Executive Officer of Holcim, Jenisch. Group Chief Executive of HSBC, Noel Quinn. Chief Executive Officer of Envision Group, Lei Zhang. And our moderator, Senior Contributor at BloombergNEF, Nathaniel Bullard.
Good afternoon, everyone. Now, I'm going to start with a very brief bit of housekeeping, which is this. You have phones, I have an iPad. Send me questions. I've got questions coming out my ears on my own, but I really would like to have some from the audience. Thank you to my panelists. Thank you all for being here. And just going to start with the scene setting, which is a challenge to do a very deep decarbonization of the global economy in a series of decades. Something that's going to cost trillions, maybe $150 trillion in that time. Something that also is taking place at a moment that could be seen as derailing any sort of options that are happening. Inflation, war, very, very tight supply and demand balances, and the sort of thing that could cause people to sort of rethink the strategies in the past that they've been on. And I think the most important thing we can interrogate today is what has been different in the past year since we convened here last in Singapore and had a similar kind of conversation about plans for getting us, if possible, to net zero by the middle of the century. So I'm going to go round robin here very quickly through my panelists and let them talk a bit about themselves, where they play a role in decarbonization, and give us a sense of their landscape. What's changed, what's working, and where they think we are. Régine, I'm going to start with you.
Great. It's great to be here. Thanks for inviting me. So CREO, which stands for Clean, Renewable, Environmental Opportunity, we're a nonprofit, and our goal since 2010 is to help facilitate and catalyze capital into, and high impact capital into climate solutions and decarbonization. We do this by working with families, so ultra high net worth families, family offices, their family foundations, and also family businesses. Why families matter? Because they manage over 10 trillion globally in their family offices, because we're going to see more than 18 trillion of wealth transferred to new wealth owners by 2030. And also because they own a big part of the private economy. And so we're talking a lot about different stakeholders and their roles in decarbonization, but we don't often hear about families and their role in this work. And so CREO early on decided to partner. We started off with American families. We now work with 200 in 25 countries. And these families are quite active in investing in solutions and decarbonization. Last year, we invested in solutions over, almost $4 billion just last year, and kind of tens of billions in transition. So what we call transition is reallocating capital when you're working with third-party managers and giving climate goals to those managers to actually invest in solutions. We have a portfolio of 1,200 climate companies, and so we're likely the largest portfolio in the world, if you allow me to call it an aggregated portfolio. We've invested in more than 210 climate funds, and the way we partner with them, we help them find the relationships they need to do the best investing. We also do deal origination for them and do research and allow them to share their best practices.
And where are they moving their sense on decarbonization in the past year, or have they?
Absolutely. So to be a CREO member, you have to be active.
Okay.
We're highly selective of who we bring into the community, and so you need to be investing in the tens of million dollars a year. On average, our families invest about $60 million a year. And where they're investing, so back in 2010, these families were investing in solar. In fact, they partnered quite a bit because we started with American families, partnered quite a bit with the government, really to create the unlocking of solar decarbonization in the early 2000s, and this is even post the financial crisis. So I'll talk a little bit about the appetite of families and their ability to be flexible and patient capital, a little bit like the pension funds. Today, it's interesting, over time, they moved from energy to food and agriculture, another big highly carbonized industry. But in the last few years, we're seeing a slowdown on the food and ag and uptake again in energy, mostly in storage. Definitely a lot of interest in hydrogen, a lot of interest, obviously, in CCUS. I'd say increasing interest in advanced nuclear. So that's on the solution side. We're also seeing our families moving from carve-out strategies where they'll say, I'll put 20% of my portfolio, 30% of my portfolio, 50% of my portfolio in direct investing in venture and private equity. We're now seeing families do whole portfolio, committing to net zero, just like the other asset owners are doing, larger asset owners are doing. And so in that case, you're really looking at how do you work with publicly listed companies to try to encourage them to deliver on their goals. There's also families who are looking at stranded assets or figuring out how to monetize doing early retirement of coal assets. So we really do invest across the spectrum, across the different sectors and asset classes.
Good, very good. Jan.
Yes, I'm from Holcim, the largest building materials company globally, and we are committed to decarbonize construction and building, so not only decarbonizing our own operations and our products, but decarbonize the way we build and the way we operate buildings. You ask about what has changed under the current challenging economic environment. I think there is no alternative for decarbonization. That has to be our future. I think we all agree we have to accelerate. Even the current difficult geopolitical situation, the war in the Ukraine, is maybe even accelerating the need for a better energy future. I mean, for us, the peaking of energy prices, of power cost is even accelerating our strategy to go fully with green energy and with renewable energy. So in a way, while the economic challenges have also been steep for us to face this hyperinflation and make it happen, on the other hand, I think it accelerates a lot on the renewable energies and the green energy we need for the future. So I'm positive, and there's no alternative on decarbonization. If you're not fast enough, the cost of climate change are going to be much bigger than the current challenges we're having.
Understood. Noel.
So HSBC, as many of you will know, have been around for 157 years. We have a $3 trillion balance sheet. About 1.1 trillion of that is direct lending to businesses and individuals. And we touch pretty much every sector of the economy, industrial sector, construction, transportation, manufacturing, technology. So from my point of view, we put out a commitment a couple of years ago that we would facilitate or directly finance up to $1 trillion of sustainable or transition financing between now and the end of 2030. And so far, we're about 170 billion through that. I'll say in the early days, that was more green bonds or sustainability-linked bonds. More recently, that's much more on balance sheet lending to projects such as hydrogen. We've done wind and solar for many years, but hydrogen, sustainable aviation fuel, other projects, battery, energy projects. So more and more that's going on balance sheet rather than capital markets. And in terms of what have I seen in the last 12 months, in all of the conversations I've had with clients, the pace of change is accelerating. I don't see the environment having slowed down the desire to move to renewables, the desire to build new projects. I don't see that has changed negatively. If anything, I've seen it has changed positively. And the need is even greater today than it was 12 months ago. There is also a recognition, because the world is never binary, that you can't just switch off today. It's about transitioning from today to tomorrow. So build the tomorrow as fast as you can, and our job is to help finance that as a debt provider. But also, acknowledge that there is an infrastructure there today that's also under pressure and that needs support as well. And our commitment is to finance the transition. It's clearly to finance green, but it's also to finance those companies of today that have capabilities, balance sheets, assets of today that need to change over the next 30 years, and therefore finance the transition, not just finance the green.
Very good. Lei.
Right. So Envision is initially we are making wind turbines, and then we gradually making batteries. So, and later on, we start to creating digital solution for decarbonization. So now we are one of the top 3 wind turbine manufacturer and also leading battery manufacturer. Today, we are building 10 gigafactories around the world. And for this digital platform, so we are managing 500 gigawatt energy assets around the world. So the logic, so for us, starting wind turbine to battery to digital, is that we think wind turbine is the new coal, is having the high percentage of renewable electricity is the first important part. Then the second part, and the battery is the new oil. So you basically is increase the electrification. Even you have a high percentage of renewable energy, but without high percentage of electrification, from 20% today to 80%, you cannot decarbonize the economy. Then the logic for digital is we have so much renewable energy around the world, intermittent, distributed, and lots of EV. You need a system to orchestrate. So that's a digital platform for decarbonization. Think about it, as you said, we are putting like a $200 trillion physical assets. What is the role for digital solutions? So 1% efficiency increase, then you think about 200 trillion performance yield. So that's the most important part. I think in the future, deal with this renewable energy system. So we are going to have 100% renewable energy system. How are we going to orchestrate this new energy system? It's become very critical.
Very good. And any change in your strategic direction in the past year based on war, inflation, supply chain challenges?
Right. So last year, we make 2 big important actions. Firstly is we're moving to green hydrogen. We take actions. We're making electrolyzers. Now we start kicking off the construction of largest green ammonia project ongoing, so which is 1.5 million ton green ammonia. And the phase 1 will be completed middle next year.
Okay.
So we are taking real actions. Because if you see lots of green hydrogen, green ammonia project, normally they'll be waiting after 2025, 2026. Let's make it in the middle of 2023. And during COVID, Envision made another achievement, is create the world's first net zero industrial park. This net zero industrial park is basically combining renewable energy production with the energy-intensive industrials. So basically, to replace grid. Think about today. So we have abundant renewable energy resources. The cost is so low. Why we cannot achieving net zero overnight? Because there's mismatching between load center and the renewable energy center. Now we are moving this load center to the energy center. You basically is going to speed up. So what we found is extremely important is we are able to find against the inflation. 100% from renewable energy, and the cost is 50% lower than fossil fuel, than coal-fired power plant. We build in Inner Mongolia, Erdos. That's a place actually producing 18% of coal of China. So this has become a very important template for this green industrial revolution.
Good. Thank you. So we've got about $750 billion a year of energy transition investment at the moment. More than half of that is in renewable energy, power, and then the bulk of the rest of it is electrified transport or energy storage, basically batteries. But the challenging thing is to really do the rest of this, to do the sorts of things to help decarbonize your business, Jan. We need trillions of dollars, and we have at the moment about maybe 50 billion a year going into it. And so I'm curious if you could give us a sense of like what your transformation need is going to be. Like what can this collective group here do to help get us from 50 billion a year to $1 trillion a year, and what's going to work for you?
I think the good news is we have most of the technology we need is available, like yours. So that's the great news. And now it's about scaling up and speed. And this is, I'm not sure if that's only a function from financing, but also to make it happen, or we need a lot of also rules, not rules, standards from the governments, how to do this. I think we have sustainability has not become a full part of the economic framework like other parameters. So we struggle in various markets where sustainability is not part of the economic framework for companies or part of the incentive scheme, which is very important. In Europe, we have the CO2 certificate market, which gives a very good payback for investments in sustainability. And we're missing that scheme, for example, in other markets to be faster and then to finance it. Because investments in sustainability, they have to be profitable. And in our case, they have been, over the last 5 years, the fastest payback investments, because obviously with the increase in energy cost, with the increase in CO2 pricing in Europe, they have been on a very fast payback track. And this is what we need also in other markets.
Good.
If I could just add, firstly, what Envision's doing is eminently financeable, and the finance will go. And in fact, we spoke just about 2 hours ago about the financing. That's all doing. The challenge that very often happens is a lot of these projects, are they done as standalone renewable energy projects outside of today's corporate infrastructure and put into an SPV? Right. Or can you achieve that requirement within an existing company, a company that's transitioning from brown to green? And if the world bifurcates, if the world goes binary, and everything green and sustainable is in an SPV and everything brown is in today's corporate structure, the overall cost of capital is going to go up. Yeah. Because the brown will become stranded, the cost of capital will go up, people won't want to fund it. And the green has a huge amount of concentration risk, project development risk, financing risk, execution risk, no cash flows to support it. The cost of capital there will be higher. So the trick is to try and leverage as much as you can the corporate infrastructure of today and take them on that journey and help them on a journey. Because they've got the engineering skills, they've got the project management skills, they know their industry inside out. And if they're committed to transition, we should all be willing to finance that. There then is a different group of projects which are very heavily dependent on government policy.
Yep. Good.
So is there an offtake agreement? Is it sustainable? Will it survive administration change? Those sort of projects, particularly in the developing markets, needs a combination of public sector and private sector finance. They can't survive alone without public policy, public sector funding, and private sector funding. There's two different categories.
Understood.
And just adding on that, from our perspective, obviously we invest a lot in early stage technologies, and we're certainly seeing an important gap in terms of getting the new technology, which obviously is managed by a team of entrepreneurs who understand equity really well, but they don't understand project finance really well. We're seeing a huge problem there. And so getting the entrepreneurs to understand how do you actually prepare a project, and because it's much more complex than equity, and making sure that the developers can also understand the technology, there's a real gap there. And so we're seeing a huge problem in terms of financing, not post, we're, at least in our community, the investments we're doing, we're seeing kind of the pilot project being financed because our families can bring philanthropic capital and concessionary capital to those projects. But project 1 to 5 are very hard to finance. And we talked last night, HSBC is one of those leaders who are kind of willing to do the hard work to come into some of those projects, but most lenders are not. And so some of our families were trying to figure out how to kind of create new new strategies and financial engineering to be able to, alongside government with the IRA, for example, to make sure that these projects are financed.
And just to back it up, my Chief Risk Officer, Pam, is in the audience to make sure I don't overpromise and underdeliver.
No overpromise.
You can see us all chuckling. The sort of it's a story as old as time. The mismatch between, in some cases, the entrepreneur and the lender in terms of expectations and project finance. I'm getting some questions. Keep them coming, please. I'd like to have too many to answer, but I've got one to pose back here, and I think I'll start with you for this one, Lei, which is that I find a lot of these conversations can be very abstract, especially in a rising rates environment. And I went back and did a little bit of math with some things that my colleagues at BloombergNEF have collated. Since 2004, there's been about $4.4 trillion worth of asset finance in energy transition, of which 3.6 trillion have taken place in an almost zero interest rate or near zero interest rate environment. And that's very suddenly not the case anymore. And so I'm curious, from your perspective, as you go to the capital market to begin asset financing, how are you reacting to the current rate environment that we have?
Right. So, the renewable energy assets, no matter wind farm, solar farm, or hydrogen project, is kind of, is a fixed capex and a steady return, and it should be the best for, for financings. But what we found, actually, the real challenge today, for instance, the green hydrogen project we are doing is not. We know the role of finance is for scaling up is very important. It's about the contract for difference. So we need to create a long-term offtake contract for our green ammonia project or contract for difference. Think about UK offshore. UK offshore taking off because this contract for difference. So this kind of a mechanism will become more important. When they creating the contract for difference, then I think it will give lots of comfort to the financial institution. They are willing to give a lower interest rate. Mm-hmm. So this is more fundamental.
So listen, the interest rate environment of the past 5 years, and you could argue for most of the past 10 years, was an artificial interest rate environment.
Yes.
0% interest is not normal. These projects will not fall over because of a 2% interest rate or a 3% interest rate. That's eminently financeable. That's not an issue. Now, for a period of time, we could be facing interest rates above that level to control inflation, but that's not the permanent interest rate level. The normalized interest rates are going to be in the 2 to 3%, and these projects can stand 2 to 3%. But I absolutely agree. In some markets, the contract for difference is more important for the new technology than the borrowing cost on the deal. Because the unit cost of energy for those new projects is going to be maybe 3 times higher than today's energy production. Not for wind or solar, but for some of the others. And it's a matter for governments to then work out, are they going to create the fiscal capacity to get some of these projects to scale for the first 5 to 10 years using contract for difference? That is going to be a much more important deal breaker on these projects than a 2% interest rate.
Got it. And Jan, in your work, like what would an equivalent novel construct be? Something contractual that allows you to do things where cost of capital might become a current issue, or where there's technology risk. Like how would you think about something similar? And what would you ask of policymakers and of the market?
Well, in our specific case, we are a building materials company, so we depend on developing the building codes. So we need the building codes to develop in all markets towards allowing us to use more recycling in our products. We can already today use up to 50% construction demolition waste into our products, and that's a big part of our investments to make all our metropolitan markets circular economies for construction. The biggest hurdle I have is the building codes which are not developed to that level yet. So I can do already 50% of recycling in my products, and the building codes allow maybe 10 to 20% at the moment. So this needs to be developed, and some markets are faster. In some European markets, we already have permits for for these super new recycled products, and other markets need a few years extra to approve the product. So that's one of our biggest challenges we're having.
But this is a very different conversation than 5 years ago, when what we would be hearing was, we need a carbon price, we need a global accord or a compact. These are actually doable things. Like a contract for difference exists in a professional realm that people understand. Building codes are localized or regionalized. Yeah. And this is, not to sound quite so much like our previous moderator Jerry saying this gives me hope, but this gives me a frame of reference in which things can happen that are not too abstract. So it's interesting to hear that.
Yeah, the challenge for many governments is, particularly in the developing markets, is convincing private sector finance on issues such as political risk and issues such as currency risk. You know, private sector equity and debt can get their head around development risk, can get their head around operating risk post-development. But many of the challenges come about by, will successive changes of administration unpick the offtake agreement or change the price in the offtake agreement? Will they unpick the subsidy or lower the subsidy that's offered? That risk is very hard for private sector equity or debt to cover. And that's where there is a role for the MDBs to come in. But for that to happen, I think the MDBs have got to change their business model, where today they tend to go vertical risk, covering all risk categories on a project. I think there's got to be more of a horizontal view, where they come in and take slices of risk off the table and use their capacity to do that for certain countries. And then the private sector can come in and do the development and operating risk. And private sector equity and debt will do it in that. So that's one of the challenges. In certain types of projects where there is a big concentration of risk, political, currency, development, new technology, unproven cash flows, in an SPV with no contingency, that package of risks in certain markets can be tough. I
would say so. I think that's a very diplomatic way of stating it.
So building on that, developing markets is definitely yet another challenge, and it's needed in the decarbonization transition. Yes, we have to figure out how to get the MDBs to crowd in more capital, and right now, in some cases, they're actually crowding out capital because of how they're structured, and that is a problem. We are seeing more and more blended finance structures, but the problem there is that they work. Typically, you'll see up to $1 billion in a structure, but they take sometimes up to 3 years to put together, because we talked a lot about collaboration over the last day and a half. Sometimes the incentives don't align across all the different players that need to come into this blended finance. And so it takes time. And there's no blueprint for this. And so I think if we're going to talk about not only deploying the capital, but accelerating the amount of capital that goes into these projects, we need to figure out new mechanisms to centralize de-risking functions around FX risk and geopolitical risk. There is talk, also I heard it a few times on different stages, around creating the new Bretton Woods for the climate era, that perhaps it is time for not just governments, but also different stakeholders to come to the table and think about a centralized function that would actually allow the MDBs to do more of the work that we and they want to do. So that's one idea that's being kind of loosely talked about.
Loosely talked about, thank you. Got a question from the floor, and it's reflections. Who here was at COP? You were in COP?
I was at COP.
Anybody else?
You were at COP.
Reflections. Tell me what it was like. For my sins, I've never been to one. So this is partly for me, but also for the larger room. Tell me what you thought about this year.
So, good questions. From Envision side, we see opportunities because we do not want to transform ourselves. We're helping people transform themselves. So many customers, so they're asking for support for decarbonization plans. But what I'm seeing is the first time COP in Africa. So there are abundant renewable energy in Africa. And they also have abundant mineral resources. So it's great opportunity for Egypt to build a green industrial system based on the green energy. So we clearly see the strong motivation of Egyptian government. So they want to build a wind turbine industry, batteries, storage, hydrogens, so lots of announcement. Again, lots of announcement. But again, what we think, we need speed. We need something should happen really fast. That's something, every time I go to COP, I have this impression. We need speed. We need to take real actions.
Very good. Noel?
The conversations were much more granular this year than last year in Glasgow. Last year was more about commitments, big numbers, concepts. We talked about, while I was there, 4 specific country plans. Egypt was one of them, Indonesia, Vietnam, and Africa. We're involved particularly in the Vietnam, Indonesia, and Egypt. And the portfolio of energy projects there, I think, adds up to around about $15 billion. We talked specifically about the structure, how blended finance can work for Egypt, how it could work for Vietnam. So we were more down in the detail of this is what the role of the MDB should be, MDBs on some of those projects. And we talked about taking horizontal risk, not vertical. They were around the table. So it was a more granular discussion. I think the other thing that we discussed, there were a lot of standard setters there as well. We talked about disclosures. And we talked about the most important disclosure, I certainly put into it, the most important disclosure a company can make is not their current carbon footprint, it's their transition plan. Knowing today is interesting. Knowing how you're going to get from today to 10 years from now and 20 years from now, even if there are some blank spots on that transition plan, you don't quite know. That narrative of how a company is going to transform itself is the most important document of the future, and not enough companies are publishing that document today. And I was encouraging the standard setters not to put so much energy into just measuring today and forget about how you disclose for tomorrow. And I don't think there's a good answer on that.
Fair enough. One moment, because I've got one for you, specifically for you, Jan, which is what's the biggest lever for decarbonizing building and construction?
Oh, wow.
Yeah, it's exactly for you. So,
there are many levers. I think I'm fascinated to make energy efficient buildings. So to have a properly insulated building, to have proper renewable sources for the energy you need. I think that's actually the biggest single lever you have. We have about 70% of the carbon footprint in operating the building, and 30% is in building the building. So where we focus on the biggest lever is to make energy efficient buildings, and that's can be happen today. We have all technology to have proper windows, proper insulation material, have clean energy sources, but we have to do it.
Okay, very good. Régine, you wanted to get a word in, I think.
Just building on kind of the outcomes of COP, I think, so data and accountability definitely is a big theme again, and so for disclosure, but also for carbon markets. I don't think we're going to get there without properly functioning carbon markets, and ideally they're regulated, but in the absence of the growth of regulated carbon markets, voluntary carbon markets need to work better, and we need credible credits both on the additionality, but also on permanence. And we did see quite a few announcements coming out on that topic. So,
did you any reflection on those announcements?
Yeah, there was a level of realism on voluntary carbon markets and the disclosures. And there's a purist view, which is there's only a fraction of the things that people do for offset that will qualify. Yeah. And then there's more modified view, which says, let's not be so purist that we stop investment flows into certain projects that have a positive impact on the carbon footprint. I don't think there was a resolution to that debate, right. but at least there was from the senior players around the table, the standard setters, there was an acknowledgement that there needs to be realism. And purists will not achieve the ultimate goal. It's about progressive improvement, not just about something that's absolute. There was an acknowledgement of that. Understood. Still a long way to go. Yeah. By the way, carbon pricing, my personal view, will never happen. Voluntary carbon markets will. Yeah. That's where the carbon price will emerge. We couldn't get governments globally to agree a a coordinated approach on COVID, the chances of getting the governments of the world to agree on a standard methodology for carbon pricing is not that high. Do I think voluntary carbon markets can set the stage? Yeah, I do. I think they can. They can do it.
Any thought to that? Briefly, we're very close to time, but what do the carbon markets mean for Envision, especially as you look out several years?
Yeah, I think same thing to the contract for difference. As long as they are pricing for carbon, then you are able to really measure the project cash flow, which is you're going to create. Then everything can become financeable. So this is also either invest by venture capital or private equity or the bank. So this is very critical.
Yeah, very good. So we're almost at time. And in fact, we're so close to time that I'm going to have to pose my question as a sort of rhetorical one for everybody, which is, this event is now in its 5th year. And I imagine we'll still be here 10 years hence. And so what I would urge all of you to think about in your time is reflecting, looking backwards on these conversations, on the issues that we talked about, on the ideas that we covered. What were we too pessimistic about? What were the things that we thought were going to be either impossible to do or they were just not worth trying? And what are the things that we were not optimistic enough about? Like, what were the things that turned out to be far easier than we thought? Not something that we can probably answer right now, but file that away in your heads for the time that you're thinking about this, looking back in the future. My own reflection is that we've managed to do a lot of things that were science experiment level of difficulty and abstraction, have now become core parts of our system. We've already won some of these battles. We just have to sort of scale them up further. And I think that we'll find the same across many different things that we see here, from hydrogen to buildings materials, to road transportation, to carbon markets, to things within the capital markets. So I would urge us all to just think of what continues to be possible as time goes on. And when we're 10 years now looking back, let's hope that most of those things turned out to be easier and moved faster than we thought. Thank you very much.
Thank you.
Thank you.